right, welcome back. Let's talk about your money matters. We see the stock market right now, 42,000 up 228, actually 236 points. And it's starting off really strong on this Friday. So this week, the Federal Reserve continued in its cautious approach to interest rates. President Trump believes a rate cut would help borrowers save on interest and spur them to spend in other areas of the economy. But the Fed says right now there's just too much uncertainty. So financial advisor with Morgan Stanley, Jim Spiro, joins us as you do on Fridays. Thanks for being here.
Hey, thanks for having me.
Absolutely. So what do you think the rationale is on this, and what really is the impact?
Well, I suggested to your viewers all along no rate cut this past week. That's transpired. Second half, I think, becomes live. Next meeting is next month, July. I'd move that up to a 50-50 by September. I think you would see a rate cut.
Okay.
And I think you see one, at most two later this year, unless the economy really goes south. I know the administration is clamoring for more, but the irony of all of that is that the behavior of the administration, particularly with the application on a broad basis, not selectively, of tariffs, has thrown a significant amount of uncertainty in the economy. So it's that very behavior that I think is enjoining the Federal Reserve to provide the administration with what it would like, which is further and more substantial interest rate relief. I think you'll get some, but I think the administration's behavior, and there are other reasons that feels it's a wise thing to do, is complicating the Fed's mission and keeping them to have one hand tied behind the back.
The tariff conversation has definitely escalated in a way that we haven't seen before. But if there's one thing we have seen before is the potential of war impacting our stock market.
Right.
So given the fact that Trump has put this 2-week window on negotiations with Iran and coming back to the nuclear negotiation table, do you think we're going to see an impact on the stock market with that?
I think it's a wait-and-see game now. The real question would be what would happen if the U.S. joined in, and I think you would see a knee-jerk sell-off. I think the real issue would be the aftermath and whether it went smoothly or poorly and what that would look like. But I think people should also give some thought to the other side of the equation, which is what is the potential for the Middle East to look like if the U.S. were successful and Iran were defanged, if you will. And I think the other thing worthy of consideration is what would happen to the U.S. if the red line, which has been drawn many times now, is basically ignored. What is the view of the rebalance of the world with respect to the U.S. and its reliability? And I can assure you that our adversaries, China, North Korea, and Russia, are also looking. So I think that's worthy of consideration, too. How much can the U.S. be relied upon to honor its red lines? So it could go either way, but I would think the initial response would be a sell-off.
Okay. So the other conversation you wanted to have, which is really interesting, because at the end of the day, it really comes down to fear. Fear of missing out versus fear of getting into the market. So how are you advising your clients to make decisions?
Well, right now, a lot of people are struggling to get in. They've seen the market move up. Everyone knows FOMO, fear of missing out. I see it all the time. Market moves up. People are on the sidelines. They hear people around them making lots of money, and that's very disturbing. Some of that's true, some of that's baloney. But it can cause them to throw good judgment to the wind and throw money at the market and frequently suffer a sharp loss. That's the fear of missing out. What you don't hear much about is what we could call FOGI, fogey, the fear of getting in. And that manifests itself largely after periods of volatility and sharp sell-offs, which we've had recently. People have to realize, you go back, sell-offs are very common. Since World War II, we've had, I think, 60 some odd of over 10%, 25 of over 20%. They got to realize, take baby steps, go in slowly, maybe look at a broad-based index fund, but the fear of getting in can be conquered if you take baby steps and approach it deliberately.
All right, that's it. It's a marathon, not a sprint. Thanks, Jim.
Thanks.
Appreciate it. Let's